You're listening to the 3D People podcast from Alexander Daniels Global, the specialist additive and advanced manufacturing recruiters. Today we're diving into a conversation on industry investment and salary trends, sparked by data from the 2023 AM Salary Survey Report, which is available as a free download from our website. We hope you enjoy. Thank you everyone for joining us today for this conversation about industry investments and salary trends. The whole idea for this came from the fact that this is the start of the 2023 AM Salary Survey Report. It's talked a little bit about investments, and we made some kind of connections between the salary trends that we were seeing, the layoffs that happened last year, and kind of the state of the of investment in the industry. So we just wanted to pick a little bit into what's going on there, where we are against predictions that came out at the start of the year, now that Q1 is over and done for a lot of companies, and just see where we should be focusing our energy as we go into the next 9 months of the year. Today I've got with me Matt Kremenetsky, who is a macro analyst at 3dprint.com. I've got Michael Molitch-Hou, who is the editor-in-chief at 3dprint.com. And then I've got Nick Pierce here, who is the director and founder of Alexander Daniels Global. And speaking is Sophie, who is the marketing executive at Alexander Daniels Global. Why don't we jump straight in by kind of setting the scene as we see it individually? Why don't you tell me a little bit about where we are now based off predictions that we were reading about 3 months ago, specifically as it relates to the macroeconomic situation in the market and the state of investment?
So I think people are definitely more optimistic at this point than they were last year. The thing is that the same way as the pessimism from last year was kind of based on like just an ambiguous feeling that everything was going to fall apart at any moment. Now it's like the fact that things didn't fall apart. People are like, hey, maybe, things weren't as bad as we thought they were. The earnings from 2022 have come in. And, once earnings are in and the markets have responded to them, there tends to be kind of like a little bit of a breath of relief, because now we can start to focus on the future instead of the past. And I think that is any optimism does feel like we're starting to move more towards 2024 stuff as opposed to 2020. As opposed to still being stuck in 2022 stuff. So I think that I've had the sense for a while that at least for the first couple of quarters of 2023, I didn't think there was going to be a recession at the beginning of 2023. And it still looks like we're not in a recession, but we're not out of the mindset of we could be in a recession. So I think people are cautiously optimistic, I would say.
I think probably, I can echo that sentiment, from the market. If I take Alexander Daniels Global as an example, we saw probably a little bit muted demand for talent in the first couple of months of this year, but then it skyrocketed in March. And talking to, a number of our companies who are smaller post-Series A funded businesses, they felt exactly the same thing we did. Coming off the back of 2022, lots of uncertainty, lots of layoffs, fear of recession. Their customers weren't buying, so they weren't investing and they weren't growing. But now their customers are starting to move deals forward and they can see good pipeline. And as Matt reflected, actually, the earnings reports that have come through from some of the bigger players, I think of SLM Solutions, for example, their report for 2022 was very strong in terms of their future order book, in terms of their growth year on year. So, I think we're starting to see now, as we enter quarter 2 of 2023, a much more positive sentiment within the market. And then aligned to that, actually, the macroeconomic factors that were probably leading us towards this idea of recession are starting to dissipate a little bit. We are seeing, for example, here in the UK, projections that inflation will not continue at the same level. As a consumer, you can already see energy prices are starting to come down, fuel prices at the pump are starting to come down, and that breeds confidence in the consumer, and ultimately that then filters into the broader economy. And again, the Office for Budget Responsibility have said that we're not in recession, and they don't think we'll go into recession. So the mood is changing as a result of the drip feed of positive information from a macroeconomic perspective, but also then what we're seeing in the market of additive manufacturing as well.
Yeah, it's interesting actually, because I read an article from Arno Held and Alexander Schmokel from AM Ventures that was published on 3dprint.com. And in that, they kind of wrote from a VC perspective that they kind of aligning with what Matt, you've mentioned about the optimism in the industry and in the market. They touched on the fact that they're not too worried about those macroeconomic factors that people have been worried about over the last months and over the last year even, such as the threat of recession, or company share prices that were dropping at the end of last year and things like that. Those things don't seem to be affecting at least the investment landscape from a startup perspective. They're feeling quite optimistic about the opportunities that there will be for venture capital companies to pump any spare funds that they do have into those kinds of startups. And so I'm just wondering, what trends have you guys noticed referencing that, and what we need to think about in terms of investments and where they're going to be going in future?
Yeah, I think what's interesting is I feel like when we're talking about the markets and recessions and things like that, sort of more of a short-term or medium-term perspective, because in my mind, additive and automation in general are going to, no matter what, keep growing, even if there's, temporary hiccups, because of some of the same macroeconomic conditions that are taking place. Like, so when we talk about supply chain issues or war impacting supply chains, when the pandemic was impacting things, all of those things are still going to drive additive as far as I'm concerned. And it's hard for me to see otherwise because I guess one of the major trends that I think both Matt and I sort of agree on is that material scarcity, resource scarcity is only going to increase in the medium to long term until there's, significant recycling infrastructure in place. And I think that's favorable towards additive because the technology is sort of designed to use the least amount of resources to produce goods. And so I think all of that is, even despite a recession, if it happens, it's still in the long term additive is going to continue to grow. That's at least one thing I wanted to contribute before we talk about specific trends within the industry.
I mean, I think touching upon what you were saying there, Sophie, and speaking to Arno and Alexander, myself, as well as a number of the companies that they've invested in, I think there's a two-tier market. And what I would sort of say is, from my perspective, at that kind of, post-seed, post-Series A level, there is still investment and opportunity out there for really, really strong companies with a good application or a strong product to enter the market, with something that differentiates or innovates. And there is a strong VC community within additive manufacturing, like AM Ventures, for example, who are funding and investing in, really smart people doing really cool stuff. But at the other end of the market, you have a number of companies who listed, there was a very high profile casualty last year, Fast Radius. You look at Desktop Metal, even Velo 3D. A lot of these companies are under pressure to start to perform and to start to, turn some of their promise, shall we say, into reality. So I think that, at the kind of smaller cap investment space, there's still appetite, but at the large cap, it's very, very tough to seek investment. And where I think companies are going to be challenged are if you're coming towards the end of your runway of Series A or even Series B, probably more Series B funding, I think it's going to be tough for those companies that are looking to get their kind of Series C. And that's where, when we talk about M&A, and this is maybe what VC are talking about, Fast Radius got picked up for what, $18 million, having been valued at over $1 billion.
I think maybe even 16 million. Like
16 million, yeah. Yeah. So I mean, I think some of these companies that are pushing for, kind of like that Series C round, that's where there's going to be, I think challenges. That capital isn't out there in the market at the moment. That's certainly my view anyway.
Well, and the interesting thing about that too is you never even know why people sour on a company necessarily, because Fast Radius got scooped up like as soon as it declared bankruptcy, and Cybridge, the company that acquired it, is planning on continuing to use the Fast Radius brand. So it didn't exactly hurt the value. And it's like anytime stuff like that happens, it's kind of dangerous because, you have kind of like less ethical actors like hanging out in the background thinking like, hey, how do we buy our own Fast Radius for pennies on the dollar? You know what I mean? And it does, I feel like, ends up probably hurting the people who work at the companies most of all. Like the people who are in the C-suite and the investors are going to make money no matter what at this point. So I think that same thing that you were talking about probably accounts for most of the I know we're not going to talk about this until like a little bit later, but probably accounts for a lot of the layoffs that have been happening. I look at them more as preemptive as opposed to like a response to the company's actual current financial health.
Well, actually, let's go down that route then, since the conversation's taking us there already. So that was one of the trends that or the connections that I wanted to discuss with you all, is how the investment landscape changing, moving away from the kind of later series funding and focusing more on the early stage funding levels has affected then the layoffs that happened, or has influenced, maybe is the correct word, the layoffs that happened at the end of last year. There was, of course, speculation around that whether it was a financial situation, whether it was just a restructuring that they wanted to do, whether it was a repositioning, like why. There was a lot of questioning around why it was happening, because especially if you're not somebody who's following perhaps the financial situation in the market or the trends that are moving through the market, you will have been completely sideswept with the layoffs. So I know that Michael and Matt, you've both worked a little bit on this, talked about this. I've seen you both publishing articles around it as well. So if you'd like to talk a little bit about that, and then maybe Nick, you can throw in your 2 pence around from a recruitment standpoint where you've seen things moving.
I think this is a little bit a side note, but like one of the reasons I love working with Alexander Daniels is like, we're not just talking about this from a sort of abstract bird's eye view of, how does the financial market work, but people's salaries and people's jobs, like regular folks are being impacted, and you as a company talk about that more than other areas of the market. So I always appreciate working with Alexander Daniels because we get to talk about the real people and how they approach the market and everything. But I guess getting to your question specifically, I think Matt's sort of right in that it's difficult to know exactly, especially with these private companies, that what is driving the motivation there. And to me, it seems like it's been preemptive mostly. Everyone was worried that a recession was going to happen, and the first thing that a callous boss could do is let go of a bunch of unnecessary people. There's a bunch of interesting companies we could talk about, but one of the most interesting would be Carbon, because of I don't know how many rounds of investment they've had. Like, I feel like they're on Series F or something like that. And like, I don't think I'm exaggerating. I think they might have actually had at least up to E. But they've been valued at, I think they're a double unicorn at this point, and they've received more than $600 million in private investment. So it's like, I think about it sometimes. I feel like I shouldn't be thinking about 3D printing when I'm not working, but like I'll think about it in the middle of the day or going to bed. I'll be like, what is going on at Carbon that they needed to let go of employees? And it's difficult to know I think one of the things, and this is something Matt and I talk about, and something we can almost see in some of the numbers that are put out there. I think one of the things is that more investment is going into software and less into humans. And so if they can automate as much as possible on the using software, then they'll need fewer people. And that's a general cost saving strategy you can see across all industries pretty much right now, not just additive. And so we know carbon is this sort of Silicon Valley sweetheart, or at least was a sweetheart. And so, you know that they're sort of thought of as like the Silicon Valley 3D printing company. And they shifted more and more to software over the past several years. They have that Lattice software, and I've heard people in the industry sort of complain that they've shifted too much to software and not enough to improving the hardware and chemistries. So that's one thing that I feel like could be happening there, is that they've figured out how to automate some people's jobs. And they're using that as a cost-saving measure. Matt and I have talked about it, and he sort of has said, like, this company's not going away. Carbon is too shiny of an object to be eliminated altogether. But maybe he could talk a little bit about that.
Yeah,
famous last words, though. I mean, how many amazing companies are there that we thought would be here in the future, and they just take the wrong path and they no longer exist? I mean, sorry to step in, Matt, you can come on, but I think just to touch upon your point about carbon, let's look at it from a European perspective. It was only April last year that they set up a European office, and then by December last year they closed it. So they invested. What changed between April and December, where you're thinking, we've recruited a VP of sales, we've recruited a sales organization, application engineers. This isn't something they've automated. They haven't suddenly worked out how to sell all their products digitally without people. They still need application engineers. They still need salespeople. No, this was a cost-cutting exercise, in my opinion, and, I can't understand if they've decided upon that strategy, early in the year and invested in setting up a GmbH in Germany, which, having done that ourselves, I know, takes time, money, and investment. And then 6 months later you're closing it down. It speaks to me that maybe the strategy is a bit up and down, and I hate to use the phrase, but it seems like the tail's wagging the dog in that scenario. Whether it's fear of recession or investor sentiment, whatever it is, this is the tail wagging the dog. Matt, sorry, you were going to pick up as well on what Mike was saying. I just thought it was important to note that.
Oh, yeah. And I definitely think that's a perfect way of explaining it. And actually, there's this guy from Stanford Business School, Jeffrey Pfeffer, who has said since last year that all of the layoffs are follow the leader, basically, and that everyone's laying people off because they see everyone else laying people off. And the interesting thing about that is that if you look back to when all of this actually started, China was the first place where tech layoffs were happening. So it seems to be that American tech companies are either trying to compete with Chinese tech companies, or they're also, the first people who are actually on the ground in China noticing that this is happening, and it just eventually spreads to the US as well. I do think carbon, for instance, when I've heard people talking about carbon getting acquired, I feel like carbon is too good of a name to fall under the umbrella of another company and just disappear. It feels like a company that since day one has been preparing for its IPO, basically. And I think that the preemptive aspect to the layoffs is not just about being afraid, but also, the stock market measures things based on two emotions, right? Fear and greed. Those are actual indexes that I forget what is the actual numerical basis for them, but it's like, this represents how much fear there is. Represents how much greed there is in the market right now. And so it's not just fear of a recession. It's the fact that investors, sadly, like layoffs. If you look at what happens every time Desktop announces that it's laying people off, its stock goes up like 10% the next day, basically. So I think that like a lot of these companies are pretty tightly linked to the institutional investors that are backing them. And when that happens, institutional investors tend to have a lot of say as to how you run your business. And the more that interest rates went up last year, people were caught in situations like you were talking about with carbon, where something that seems like a good idea in December 2021 by March 2022 no longer seems like a good idea. You know what I mean? But it's already in the works. And so, you go with it and see how it's going for like a few months. But I think that's really a testament to how quickly everything moves now.
I mean, I think Desktop's a good point, because if we look at some of the layoffs that have taken place, was it follow the leader? Was it required? Was it due to economic uncertainty? Actually, having gone on an acquisition sort of sprint, if you will, over a number of years, actually, there probably was a bit of fat to be trimmed in a company like Desktop Metal, where you've got duplication of roles across multiple different businesses. Do you really need multiple sales organizations, for example? Do you really need multiple back office functions, HR, legal, procurement, finance? Actually, it is sensible, and where you do get good economies of scale from acquisition are if you can seamlessly integrate the businesses, with a sort of shared service model for back office support, an integrated sales team that are selling multiple products across multiple markets. Then you can achieve cost savings that are beneficial for the business. And maybe that was the right thing to do. But I think in some of the other cases, and let's just jump back to, when we went into, kind of COVID, we saw huge layoffs, in particular in the US, a lot less in Europe. And, we referenced this sort of data in the salary survey from, sort of 2022, where we look at hiring and, percentage of people changing jobs. But I think the short-sightedness of layoffs that companies often do is, not based on long-term thinking, but rather short-term cost saving. And actually, in the long run, ends up costing them more because, when the market rebounds, and inevitably it does rebound at some point, you're only going back out to try and find that talent that you've let go of, and it might be more difficult to get. And the funny thing is, despite all the layoffs, I mean, I think it probably did take one or two people a little bit longer to find jobs, where, in a really booming market, you'd be out one day and within a week you'd have found something else. Maybe it did take 2 or 3 months, but we still see candidate scarcity. I think that whole layoffs that we saw, it doesn't seem to me, or doesn't feel to me, that there's lots of people out there now still looking for jobs, 6, 7, 8 months on. So what happens when the market does start to improve? These companies that made those layoffs and then come back to find talent are going to be like, where's all the talent gone? Oh, they've gone into robotics, or they've gone into industrial automation, because those companies are a little bit more, those industries are perhaps a little bit more mature than AM and aren't swinging up and down quite so much.
So this is an interesting point. I'm sorry, Mike, if you had something to add to that, I'll let you talk first, and then I'll go on to my question about that.
Oh, I can just make it brief. I think Desktop Metal compared to like Carbon that's a great comparison, because you're talking about a private company versus a public one. I didn't mean to say that all they were doing was automating away jobs. I just meant that's a general strategy that I think is worth paying attention to. And yeah, obviously does not explain their layoffs altogether. But with Desktop Metal, like Nick said, I think that's one of the more sensible restructurings we've seen. Is they acquired a bunch of companies and had a lot of redundancy. And when I talk to former employees there, because sometimes some companies have a negative reputation and their CEOs might And I talked to companies, former employees there, and they didn't seem to have, they might have some ill will toward a manager they had or something, but people actually generally didn't have negative things to say about Rick. And they seem to agree with the strategy from like a business perspective. So even if they have a personal issue with being, laid off, nobody likes that. From a business perspective, the people I talked to thought it made some sense that they were laid off.
No, it's an interesting point, and kind of bringing together everything that everyone's just contributed on that. One thing that I think we've noticed or started to notice at Alexander Daniels Global is we come across some candidates now, if we're talking to them, who are asking the question, is it worth staying in additive manufacturing? Now, Nick, you touched on it a little bit, that they either move into robotics or automation or things like that. And I think there is a little bit of a ripple effect of the layoffs that happened and the financial situation that the market is in right now. I know we've said it's a positive in the end, but we've just come through a period of uncertainty, let's say, and it's left candidates unsure about whether it's the right industry to stay in. So my question to you is, how do you think this is affecting the reputation, not just of the companies who did the laying off, but also then of the industry as a whole?
Maybe I'll dive in first on that, because I'm probably closest to the market there in terms of talking to talent about this. And I mean, I think job security is pretty good in AM generally. As I said earlier, most of the people who were laid off, found it relatively easy to, pick up other opportunities. And to pick up on a point that Mike made earlier, yes, you have, a little bit ups and downs, but still the industry is growing and will continue to grow. So, for the foreseeable future, at least the next 10, 15, 20 years, we're still going to see probably close to double-digit growth within the broader additive manufacturing industry. And therefore, there will always be opportunities for talent. And, certainly from our perspective, the global talent pool is not growing faster than the demand for that talent, within organizations. So just to touch upon that point, I think that there's, a degree of optimism for anyone in the industry. But, does the layoffs that have been done create a negative sentiment for the industry? I mean, I would say, anecdotally, yes, it does. I think, we've certainly spoke to people, and, one of the things that we're trying to do more and more is bring people into AM from other industries. And that's what companies are looking for now as well, whether it's technical experts with backgrounds in aerospace or automotive or medical, or whether it's salespeople that have operated in robotics or industrial automation. Yeah, some of those people probably are a little bit more wary of additive manufacturing as an industry. As for the companies themselves, yeah, I mean, I think that the funny thing is, we can talk about, the likes of Desktop Metal and Carbon, because they're very vocal in their layoffs. But, let's not hide the fact that EOS as well, while not sort of shouting about it, were quietly laying people off and strategically downsizing certain areas of their business. And I mean, that doesn't come from them, and you don't see that in the media, but it was happening across the board. And actually, I think probably what we sort of see is then that the companies are open and honest about it. And as you just sort of touched upon, there's no ill will from the people that have been let go. Actually, there's perhaps a little bit of an undercurrent where the companies who aren't so open about what they're doing, and it's trickling out into the market, those people are more disgruntled, and then that does create a little bit of negative sentiment towards some of these organizations that makes them perhaps less attractive for talent.
I guess, yeah, I think you do probably have a closer to the market perspective, so you can sense that more. I think the thing that I would sort of reiterate is like AM's not going away, and it's definitely going to just keep growing for the foreseeable future, I think it's part of a broader Industry 4.0. As much as that used to be a catchphrase, it's part of a larger shift to automation as 3D printers are manufacturing robots. And so I don't think the manufacturing sector has been working on automation since World War II or, before. So we're just starting to hit a critical mass of technologies that make it a reality. And I think the disgruntlement will come in when these machines are actually able to take people's jobs. And that's a different topic altogether, pretty much. But it's that we're going to have to think about more and more as people in the industry, because we are humans, and we work with humans. And I'm sure you guys have opinions about whether or not jobs are going to be taken, but at least my opinion.
I think just to sort of touch upon that, but sort of slightly taking us back as well, because additive manufacturing, as you rightly say, Mike, sits within this broader kind of Industry 4.0 sort of segment of the market. And certainly under the current administration in the US, there's a significant drive towards kind of reshoring manufacturing, and an enabler of that, where, for example, certainly historically, it's been, low cost economies, the drivers of manufacturing simply because of the labor cost, where you sort of say a machine's taking jobs. Well, actually, yes, they are, but where are they taking jobs from? If we're able to use the technology to reshore manufacturing, we're taking jobs away in low-cost economies outside of the US, for example, and we're bringing back high-value jobs into the US, or into those markets who are able to invest in and adopt this technology. So I think that's one part, and that's attractive for talent. And I think if we can see that future, it's a future where, yes, we are probably going to lose some jobs that are less skilled, but we will create more jobs that are higher value, higher skilled jobs. But I think the other point I wanted to make, it sort of comes back to a little bit, where are the drivers for the industry at the moment, from a market standpoint, because I think that's important to touch upon as well. And again, this speaks to a little bit the macroeconomic factors and, the broader world sort of landscape. We are at a time of war, shall we say, in Europe between Russia and Ukraine. It's not surprising that what we see happening is huge investments in defense. Now, almost every day I see something new being written about a contract for the Navy, contract for, the Department of Defense to invest in additive, and this is really driving opportunity for the industry. I mean, Matt, Mike, I don't know whether that segment, defense related spending that drives additive. Are you sort of seeing that, from the stories that you're doing?
So defense is actually, it already was last year, because last year was my first year writing full time. That was already like one of the main things that I was writing about, probably energy more last year. This year I've been writing mostly about defense, and even the energy stuff that I'm writing about crosses over with defense. So the really interesting thing that's happening in defense spending right now, especially in the US, where all of that money is coming from, is it's military, but it's not necessarily, like munitions and stuff like that. It's green jobs. A lot of the investments that the military is making right now are things like, automated or research and development into like automated production lines for what are probably going to be electric vehicles. And this is happening in some of the main US states where automotive production takes place. So the thing you said about the Biden administration, like, that's exactly right. And I think that's there's a lot of cognitive dissonance, I think, between the idea that we're going to be going into a recession any day now and the fact that during a 2-week span in March, the private and public sector in the US combined announced over $10 billion in investments specifically in manufacturing, which, I think it's hard to keep in mind like how much is a lot these days. Like 10 billion we're used to hearing about trillions, and we're like, yeah, 10 billion, that sounds like a lot, but I don't know. But for real economy stuff, that is a lot of money to be going into the American economy. And the thing is that once a few companies announce it, the follow the leader thing comes back again. And, it's not just going to be those few companies. It's going to be like any company that wants to compete with those companies. So I think that on the one hand, people are right to be nervous about the economy. I think people are always right to be nervous about the economy when we're trying to connect the supply and demand of the entire planet every single day to each other. But there's a lot of reasons that are getting less attention that can kind of make you feel optimistic about longer term things like green jobs and like the fact that they're starting to move chip production into more than one place in the world. I'm trying to think. I know there's other stuff, but those are the two main things, chips and renewable energy. The fact that not only are people aware of those things, but there's actually money going into those sectors to reflect that, I think is a pretty big deal.
I guess when we talk about reshoring of manufacturing, I think Matt has privately expressed some interesting ideas about what that means. And I think if we talk about a resource, so I don't know how widely known it is, at least in the United States, it doesn't seem to be super widely known, but I see Europeans post about it occasionally on LinkedIn, that these resources are finite. And so when we talk about reshoring, I think it has less to do with, supply chain. That's what it is. It's supply chain resilience, which is crucial to the reason that reshoring is happening. But I think it also has to do with resource scarcity. And so when we talk about high-tech jobs, we're making everything a little more domestic in these first world countries so that we can make our high-end goods locally. So I think the question we have to ask about reshoring and manufacturing is if we're going to shift to making higher end stuff and less of it and less disposable stuff. Going back to the defense manufacturing thing, defense has always basically guided additive manufacturing. The first article I wrote about additive manufacturing was America Makes, before it was called America Makes. And now what we're seeing is sort of the fruition of America Makes and similar organizations around the world integrated into the larger defense supply chain. So they were building up all the research, making all the technology suitable for defense and military applications. And now that it's been 10 years, it's ready to saturate the defense market.
On that note, actually, we talked a lot about defense and military, and they're steering the direction of manufacturing, as you've all pointed out. What I'm wondering now is, they're not the only market segments that additive manufacturing touches. Now I know that it's growing a lot in terms of it's getting a lot of attention lately, and it's going to continue probably throughout the rest of the year to get even more attention as the applications of 3D printing brings out other developments within those markets. But what I'm wondering is, what does that mean for the other market segments that use additive manufacturing technologies? Where are we seeing that? And if we're bringing the conversation back a little bit towards investment and where the investment is being directed going forwards, what does it mean for the other market segments?
Something that I mention a lot when I talk about all the money going into defense is that it's not going to be for every company to work with the government, and that's not just, if you're like a libertarian or something. That changes your entire business model to get into like what's called the military procurement supply chain. Right. That basically, kind of solidifies that's what your company is going to be. Right. But all of the military spending is essentially economic stimulus, and people can act like it's not, like it has some reason for existing other than that, but that is the main reason that it exists, right? The Inflation Reduction Act and all of the military spending going on right now are directly related. So the effect of that is that every company is going to benefit from the money that the military is putting into AM regardless, because it's going to grow the market. It's going to create a larger labor pool for additive manufacturing talent. It's going to lower the costs of materials used, both in terms of making the machines and in terms of the inputs. And the main difference is that obviously the companies that work directly with the government are going to get the biggest share of the pie first, right? But any company that's not specifically trying to make weapons or something like very obviously exclusively for defense, they're all going to benefit too, because the entire strategy behind the spending is actually to create what the government is calling like advanced manufacturing clusters. And that's even, I think, mostly going to have an effect on semiconductors more than on pure defense stuff. And that's really long-term what I think all of this buildup is going to have the biggest effect on.
Right. Great. Nick, do you have anything to add to that? What do you see in terms of the market segments and how they're moving?
I mean, I think that there's if we're talking purely AM, we touched upon defense, and I think that's a big driver. We've talked about clean energy, and I think that's a big driver. Clearly, additive is a really big enabling technology for, EV type opportunities, whether that's cars, rail, buses, taxis. I think these are all areas. I think we sort of talked about semiconductor, sort of 3D printed electronics. This is a big area where, there's a lot of opportunity for this industry going forward. And we can't overlook, things like medical. And I know that some of the kind of 3D printing technologies that are starting to come to market now are quite niche. But, as we expand beyond what we see from a prosthesis standpoint, reconstructive surgery standpoint, the application for bioprinting in the future, I think is really revolutionary. We're already starting to see some of that now. And fast forward 4 or 5 years from now, I think we will see 3D printed organs that, can be transplanted. So I think it'll be exciting to watch how that evolves. And, while probably there's less investment into this because it's very patient specific, whereas the kind of macroeconomic benefits of investment of government into defense gets filtered out and down, it's less likely in medical, but I do see that as an area that continues to grow. And just sort of coming back to where we started, when I talk to the investors, the people who are looking at what do we want to invest in, application based solutions, and that can cut across a whole plethora of different industries. Application based businesses who are leveraging AM technology, they will get investment if they can prove the business case.
Okay, brilliant. I just want to move on a little bit now and into the territory of salaries. This is one of the topics that we had in mind to discuss as well. So I guess, Nick, this is probably going to be your area of expertise a little bit. So I guess it's aimed a little bit at you, but please, Matt and Mike, if you've got any thoughts or comments, please do contribute them as well. Now, the connection that I'm curious about is whether industry investment and the situation that we discussed at the start of this conversation impacts how salaries develop and change and what the trends are within salaries in the industry. So the 2023 AM salary survey report, it did reveal that despite the instability that the market was seeing towards the end of last year. You had the US, which was increasing salaries across the board by something like 12.6%, I believe it was. You had the APAC region as well, which was increasing salaries across the board by 7.6%, I believe, as well. And then you saw the EMEA region instead that was reducing salaries across the board by 2.5%. So, Nick, I just wondered if you had any comments around that, why that's happening. Is there a connection there between investment trends, market stability, and the salaries that then come out on offer?
I think what we have to look at, in terms of salaries for last year was that we were in one of the hottest job markets that have ever existed in the first half of 2022. 2021 back half, first half of 2022, one of the hottest job markets that's ever existed. And that is probably where the driver was as far as the augmentation of salaries across the board could be seen for the US and for APAC. I think Europe, it's always an interesting environment. We talked about earlier a little bit the fact that, when COVID hit, we saw, layoffs in the US. We didn't see the same layoffs in the US. So when you have the uptick in demand and a really hot jobs market in the US, which drives up salaries, in Europe, it's always been fairly consistent and fairly steady. So there was no big boom in demand for talent because there was no big drop off in layoffs. So, we probably see more realistic data in Europe than we see in the US, for example, because of the boom bust kind of mindset. Whereas Europe, actually, I think that the trend that we saw is probably more reflective of where salaries were heading towards the end of last year. And I think if we did the salary survey now versus when we collect the data normally, we might find that sort of growth in salaries in the US and APAC would probably be more flat, as a result of the macroeconomic conditions. I think the challenge here is that we still aren't in an environment where there's an abundance of talent. There is still demand and there is still growth, and actually talent are facing pressures. It's abating a little bit, but when inflation's at 10%, actually it's quite reasonable to understand why when a candidate moves jobs, they want a 10% increase in their salary, because actually that's net for them then, in terms of, like my daily life costs me 10% more. If I earn 10% more, I'm kind of at the same level I was. So it's not unsurprising to sort of see a correlation between economy and salary, in particular when we're in an inflationary economy. But as we start to see, as is probably expected, inflation reducing, I think we'll start to see the normalization of salaries coming back into line with that. And if I were going to make a prediction for what we might see this year, I would sort of see that probably the US, we might see flat to 5% growth in salaries, likewise in APAC, and again in Europe probably flat to sort of -2% in terms of salary growth there. So there is definitely a correlation between economic factors and salary growth, that probably been a bit of a driver. From an investment standpoint, is this a driver? Well, yeah, clearly it is, in the sense that, investment drives demand, and if demand goes up, and supply doesn't, which it isn't, and actually I think we are going to see a little bit contraction supply of talent because of economic uncertainty. We definitely started to see that towards the end of last year. Less people looking to change jobs. Then, if that investment does come, we might see that have a push on salary factor as companies need to pay more to secure the talent that they need. And, let's not just talk about people changing jobs. Companies want to retain their best talent. And, a way to do that is to ensure that they're paying market rate, which means maybe increasing salaries for existing employees too. So I think there's lots of factors that can affect salary. Investment can, economic factors can, appetite of candidates to change jobs. All of these things have an impact on what we'll see as far as salaries are concerned.
So one of the things you touched on there was with kind of inflation in the market, people are starting to ask for salary increases as well when they're changing jobs that match that level of inflation. Now, one thing that makes me start to think is, what happens then once that inflation slows down and they've received that higher salary? Is that going to imbalance the kind of salary landscape in the market? What's the general effect of that in the longer term?
there's lots of things that can imbalance the salaries in the market. I mean, we've seen historically companies, we've mentioned a few of them before, the likes of Carbon and Desktop Metal, when they were on huge kind of growth trajectories, paying above market rate salaries. That probably has a bigger impact, truthfully, on the landscape, because it kind of forces everybody to step up to just compete. But I think as inflation starts to dissipate, hopefully as the year continues, will we see then, salaries reducing? No, because it's like a ratchet. You go forward, you don't come back. It's like with energy prices, we get used to paying a certain amount of money. Does the energy company start reducing our bills straight away? Of course they don't, because we're used to paying that amount of money. Will the goods in our shops go down? Probably not directly in line with the reduction in inflation, because we get used to paying that, and actually our salaries have gone up, so they don't need to. They can earn a bit more margin. And I think that's what we'll see, to be honest. I don't see salaries going backwards with inflation.
No.
I think they'll stay at the level that they're at, certainly not going backwards, not by much anyway.
Okay. Well, from the talent perspective then, because there will be people who are changing jobs throughout the next 9 months. So we've got a long time left in 2023. We're just at the start. So from the talent perspective then, what would you say they need to bear in mind when it comes to salaries or negotiating salaries based off of the direction the market is going in? Is there a certain area of the market where they might be able to receive a higher salary rate, let's say, than in other parts of the market? What's your thinking on that?
Look, the good times aren't here now, right? Like there were times where if you wanted the salary and you believed you were good enough to get it, there's a company out there probably willing to pay it. That's not where we're at now in the market. Okay, so I would just encourage realism and a bit of expectation management now amongst anybody who's thinking of moving jobs. Yes, you probably are feeling the pressure because of rising inflation rates, but actually companies are feeling that too. And so, like I said, the good times where there was money growing on trees almost, it seemed, lots of investment flying into the industry, and therefore companies prepared to pay top dollar for the best talent. Look, companies are still prepared to pay good money for the best talent, but, it's not being handed out freely. So, I would encourage candidates to be realistic in their expectations if it comes to either negotiating with an existing employer, a raise, or, when searching for a new job. If you're expecting, more than a 10% increase on your existing salary, then, I'd say that's highly unlikely.
Okay, great. Right. If I could just ask all of you to summarize what the next 9 months will look like, based off of everything that we've talked about in this past hour, what is the outlook within additive manufacturing for the rest of the year?
I guess so one thing that we didn't talk too much about is that the software segment, at least based on the numbers from SmartTech, was the fastest growing segment. So I think it'll probably continue to be the fastest growing. I think it grew at 33% compared to last year and was worth about $1 billion this year. I also think the industry is going to grow way faster than most people expect, and it's in large part due to a lot of government spending on manufacturing, specifically for supply chain resilience and decarbonization. And so a lot of the military announcements you've seen already and noticed, we're going to see a lot more of those. And we're going to see a lot more dedicated to decarbonization. So oil companies using 3D printing, and then also the semiconductor industry also.
So basically for those same reasons, like the defense and government money that's coming in, I think materials is actually going to be like the biggest thing in 2023. And I think it's kind of interesting that people seem to forget how primary that is to everything else in the industry. But like just going back to when people first started taking 3D printing seriously, like the classic explanation of how the economics of the industry was expected to work is the razor and blade model. I don't know if you guys are familiar with that, but basically just that Gillette sells people razors or the handles at a loss so that it can sell you the blades at a huge markup. And that's kind of, the relationship between materials, the blades, and the handles, the hardware. So I think that for everything else in the industry to scale up the way it's been projected and the way it seems like it can, materials has to be like the first thing that gets put into the supply chain.
What will the next 9 months bring? I think, there's a lot of optimism around right now. I don't think that that's going to change. I think we're going to see, a fairly buoyant additive manufacturing market over the next 9 months. What that means in the context of what we've discussed today is I think that we will see continued investment at the bottom end of the market that will drive opportunities, for growth and jobs, for application-based technologies that are leveraging additive manufacturing. I think we could still see a little bit of consolidation at the higher end of the market, as we discussed, with those companies stretching towards their Series C, maybe not being able to make that and therefore being acquired by the aggregators that we see in the industry right now. Obviously Stratasys being one of the major ones, and obviously Nano Dimension have signaled their intent, and they are probably, if they don't land Stratasys, going to be looking for something else. Carbon might be, a good reverse merger for Nano Dimension, for example, where that brand could be a good target for them. So there's maybe one prediction. Let's see if that one happens. You heard it here first, right? Nano Dimension acquire Carbon. But the other thing, and just to touch upon what Mike said, software, we see it, we established our software specific recruitment business alongside or within the Alexander Daniels Global business. And in first quarter of this year, they are 100% ahead of where we expected them to be. And I think that will continue to be an area that will grow within the market and is really exciting. Is probably where, hardware was, maybe 10 or maybe not 10 years ago, but, sort of 5 years ago, lots of really exciting companies bringing out new technologies that are all trying to find their place within that kind of software ecosystem. A little bit more competition coming into the market as well, making it more challenging. But, I think that's certainly one area of the market to keep an eye on.
Perfect. Thank you so much to all three of you. I think this has been a really, really interesting conversation. I've at least enjoyed it, and I've learned a couple of new things too from your perspective. So thank you for joining me, and I look forward to speaking to you all next time.